Welcome all to this Wednesday edition of Inside India. I'm Sri Jegarajah. Let's take you across the headlines. US Treasury Secretary Scott Bessent calls India out for being a bit recalcitrant in trade talks, with local media saying New Delhi is preparing for Prime Minister Modi to try and get some face time with President Trump in the US next month. India's market regulator SEBI is looking to further simplify rules to boost foreign investment flows. And Tata Group's Indian hotels company pushes further into the mid-tier mass tourism segment, snapping up majority stakes in Ankh Hotel and Pride Hospitality. We'll be speaking with CEO Puneet Chhatwal coming up on the programme. Let's take a look at the Asian markets, and they are looking constructive following the strong lead and the record lead that we had from Wall Street overnight. So the markets clearly, on a global basis, are responding to this 90-day reprieve and the trade truce between US-China being extended, and hopefully later on this year, that may culminate in a Phase 1 style trade deal between the US and China. So the optics seem to be moving in the right direction insofar as the US-China relationship is concerned. It will be interesting to see if Prime Minister Modi does travel to the US, as some local media reports in India seem to be indicating whether he can salvage a trade deal with the United States after some of the arguably irreparable damage that's been done with 50% tariffs, which has really polluted the atmosphere. With that, US Treasury Secretary Scott Bessent is taking aim at India over trade talks, telling Fox Business that New Delhi has been a bit recalcitrant. He also said that the Trump administration hopes to wrap up all trade negotiations by October. Cracks have started to emerge in the India-US relationship after President Trump slapped a 50% tariff on goods from New Delhi, among the highest faced by any US trading partner. As I said, some local media reports suggesting Indian Prime Minister Narendra Modi will be heading to the United States next month. Prime Minister Modi will be attending the UN General Assembly in New York, the Indian Express newspaper reported, citing sources. Another key objective of that visit might be to meet US President Trump and resolve ongoing tariff issues. Indian markets will be joining us in about 40 minutes' time. Let's give you GIFT Nifty futures, and they are indicating an opening number in the region of 24,635. So if that does materialise, then that does represent a significant lift for the benchmark, considering where we left off at 24,487. Let's give you the dollar rupee exchange rate, 87.544. So just marginally in favour of the Indian rupee when you look at the exchange rate. Now, Tata Group's Indian hotels company is making a big play in India's mid-scale hotel market. IHCL will buy a 51% stake in both Ankh Hotels and Pride Hospitality, which together run over 130 Clark's hotels and resorts properties. The $23 million deal is set to close by November the 15th, and it will expand IHCL's reach across India and Sri Lanka, while a new tie-up with Bridge Hospitality adds 19 boutique hotels. IHCL is the owner of hotel brands like Taj, Vivanta, Ginger, and these new deals are a part of their asset-light strategy to strengthen their network. Let's bring in Puneet Chhatwal now, Managing Director and CEO of Indian Hotels Company Limited. Puneet, welcome to the programme. And let's start by helping us understand the logic behind the acquisition strategy in both the core market and the broader Indian subcontinent.
Good morning, and thank you for having me. I think there are a few key reasons which made this a very compelling proposition. Number one, it's in light with, it's absolutely in line with our growth strategy. We want to be leading the growth pack, especially in our home market like India. Number two, within that market, the mid-market play today and over the next 5 to 10 years is going to exceed almost 500 million kind of addressable clientele, which represents 1/3 of the Indian population. Number three, the continuous GDP growth is encouraging spend in this sector, especially on the domestic front, both on a business as well as on a leisure basis. Business because of the emerging markets in the tier 2, tier 3 cities of India, where new airports are coming in. Number four, it gives us, through the conversion of these hotels, the majority of them, let's say around 85-90%, to the Ginger brand. It gives us a head start in the mid-market, where we would be leading the mid-market segment with our existing Ginger value proposition. And we have made some serious investment in Ginger brand in the last 5 years, as well as put in a lot of talent and good leadership behind it. So we are very bullish on the future of the mid-market to complement the existing strength of luxury, which is obviously led by Taj, not just in India, but on the global front.
Indeed. Puneet, talk to us about what's in store and the prospects for the Sri Lanka market, because earlier this week we were speaking to John Keel's Holdings, a major conglomerate there, I'm sure you're aware of them, who are now in this partnership with Melco to create City of Dreams, a gaming resort, a casino, integrated resort is how it's been described here in Singapore. How important is the Sri Lankan market now that there is that arguably new driver to the tourism sector there, and they are targeting the Indian visitor?
You know, the Indian subcontinent per se is also important for us. Anything around India, whether it's Maldives, it's Sri Lanka, it's Nepal, all these countries. We're going to open 2 hotels in Bhutan. We have had good presence in Sri Lanka with 3 assets, and one of them being a leading asset, the Taj Samudra in Colombo, as well as our resort, the Bentuta Resort, which is very popular among Indian guests. After a couple of years of political challenges, I think Sri Lanka is coming back strongly, and we are seeing a strong revival in both rates and occupancies, and we expect this trend to continue.
Puneet, I know it's a very sensitive subject. You touched upon the political unrest in Sri Lanka, but also turning to India, how destabilising was Pahalgam for the industry and for IHCL, because J&K was enjoying something of a tourism revival until then.
Well, actually, Sri, it's interesting. The people are still going back in big numbers to Kashmir, and we have the Faith Conclave. Faith is the federation of all associations in India's tourism and hospitality. I chair that conclave. Today is the second day of the conclave, and very interesting, the Chief Minister of J&K is the first speaker today. So all in all, we are very pleased. We are behind. These things will, can derail us for a few weeks or a few months, but ultimately we have seen the resilience in the sector globally, whether it's a 9/11 or a 26/11 or J&K, things just bounce back, which is a bit unfortunate because the memories are short, and at the same time extremely fortunate that the life goes back to normal.
Puneet, just help us understand what verticals and what demographics and what kind of traveller and audience you are targeting, and help us understand, and I find this immensely interesting, spiritual tourism. I would imagine that's ashrams, temples, pilgrimages, yoga retreats, and how IHCL is trying to meet that demand in that part of the market.
It is something which is a very positive surprise. India always benefited from the wedding segment, which was and remains a very large social gathering, and a lot of money is spent on weddings. Now this is getting complemented, as you said, through the spiritual segment as well as the medical tourism, kind of Heal in India campaign together with Make in India. But spiritual segment surprised everyone with the visitors to the Mahakumbh, which happened very recently. And we see this as absolutely crisis resilient segment. And it's on a very big upswing. And the current deal that we discussed just now also helps us because some of these properties of A&K and Pride are very close to all these spiritual destinations in the north. And that will help us now to further expand in the temple tourism circuit in the south.
Puneet, it's not all hunky-dory, though, in the global economy, and arguably there are some parts of the Indian economy that are still struggling and still vulnerable, and especially when you consider the risk of unemployment coming from higher tariffs, if that does materialize. How is all that impacting IHCL within India? And can you give us your insights as to how you think festival season is going to shape up, given that balance of risks?
Well, Sri, there are all the time risks. I mean, the sector has seen COVID. COVID meant a complete lockdown, revenues dropping to zero. Having had that behind us, I think the sector in general, and for us as a company which is net debt free, which has cash reserves for any kind of negative headwinds that may come across, we feel fairly confident and know what is to be done should there be any kind of negative development in the market. Having said that, at the moment, we are not seeing any signs. Of course, there was a softness because of the Kashmir issue. Then came the Operation Sindoor, the conflict between India and Pakistan, followed by an airline accident, followed by the Middle East conflict between Iran and Israel. So all these are kind of events that created temporary softness between the months of May and July. But we are seeing a very strong development in August and also a great development on the business, on the books for the months of September and October.
Puneet, can I bring in China? And it's noticeable, isn't it, that China and India relations seem to be warming. China's relaxing the rules on travel for Indians. Then is there the prospect, therefore, of some two-way trade going on here and Chinese visitors coming into India, more Chinese visitors coming into India, or is there still some bilateral and diplomatic work that needs to be done before we see that?
I think this will evolve over time. At the moment, we are not really that prepared to, like as if we are expecting millions of Chinese people coming in as tourists into India, not for this fiscal for sure, but things may change in the next year tourist season. Efforts are being made and, we welcome any kind of efforts that help give buoyancy to our sector.
Let's talk about the longer term and Accelerate 2030 and IHCL's 5-year roadmap. How does that fit into the bigger picture at a policy level, perhaps, Puneet, and at an aggregate national level? And what kind of company or what kind of hospitality brand does or will IHCL look like after that 5-year period in 2030 and beyond?
Sri, thank you for this. Is an interesting question. We commenced this journey in 17-18. Actually, February 2018, we first announced Aspiration 2022, followed by our targets for 2025 under Ahvaan, and now Accelerate 2030. We expect, the strategy that we embarked upon, moving from a branded house to a house of brands, that all these brands would have matured, and the reliance on the Taj brand solely for revenue and profits would kind of not be there in the way it was in the preceding 10, 20, 30, 40, 50 years. So going forward, Taj will still be the backbone. Taj will still take the lead and will have the charge in terms of the total revenue and total EBITDA, but it will get very good support with the maturity of brands like Ginger, Vivanta, Gateway, selections of our homestay with Ama, and also the boutique luxury collection in terms of Claridge's. So all in all, I think this is the time we need it, and our goals that we have guided the market for were 700 hotels. Today, we are at a portfolio of 550 with the conclusion of this deal in November. And very much on target with our guidance on return on capital employed of 20%. We are closing to 18 now, and we still remain net debt free. We have a small debt in London, which we expect to pay off following the approval of the Reserve Bank of India.
Puneet, I'm glad you mentioned Europe. I just came back from, in June, I came back from a very memorable holiday in Italy. And I noticed there were many Indian visitors there. What are you doing in the European market to develop your presence? And by the same token, what are you doing in the Middle East? Because the GCC India economic corridor, that is really flourishing. I mean, there's no shortage of NRIs that are traveling there and even starting to live there in Dubai and the Emirates.
And that's absolutely right. We have 3 hotels in operation in Dubai. We are under development with extended stay in Ras Al Khaimah. With Taj Wellington Mews, we have signed up 2 contracts in Bahrain, and we are under development with 2 properties in the Kingdom of Saudi Arabia, all branded as Taj. We're also looking at standalone restaurant, both in Dubai and in Bahrain. Hopefully, we'll have closure on one or the other. But Europe, very interesting. We are going to open in the next 4 to 5 months the first Taj on the continent in Frankfurt, and we are negotiating definitely one or the other contract in Switzerland, which is, after London, the most favored destination of all Indians. Of course, I personally also like Italy, Sri, so I like Italy and Spain, but my personal liking comes second. First is the business.
Yes, Indians are like the Italians of Asians in many ways. Puneet, it never fails to strike me when I am at your properties in India, especially when our team was covering the election in Delhi, that just the quality of the people that you employ, your staff, front of desk, and in the lobby, and the staff who clean the room, it's just exceptional. How can you continue to keep up that standard of excellence? And are you finding the right people at all levels to do this job?
You know, this is something which we define as the DNA of our company, and the core values of that DNA extend across all brands. Taj, maybe, Sri, you were not aware, Taj we defined as trust of all stakeholders, awareness of the communities we live in, and J for the joy in doing whatever we do. So I think you can change your business strategies for 2030 or 2025, but you don't change your core values every day. And I think this is so deeply inculcated in our DNA that anybody who comes and gets absorbed, and of course we keep working on the talent. We keep investing in the talent. We keep giving exposure to the Western world, to the Eastern world. People from Dubai coming to India, Indians going to Dubai, people going to London, people going for higher education in Europe at all levels. So a lot of that keeps happening. But most important is the core values of Taj, coupled with the 5 core values of the Tata Group. And I think that is something extremely special in a group like Tata and with all the Tata Group companies.
Puneet, how are you integrating AI into the value proposition at IHCL? And do you think we'll ever be in a situation, and hospitality is so customer-facing, you need that human touch, especially with concierge services. Do you think we'll ever be in a position where you have robo-staff or the human touch is replaced?
Not in foreseeable future. We look at AI and machine learning as an enabler for various verticals, be it revenue management, be it assisting a concierge, be it for other customer marketing data or customer relationship management. Having said that, the key differentiator or the USP of Asia in general and India in particular is the warmth of the hospitality. And that warmth is not yet delivered through machines and robots. I think that human touch is important, and we are in people business. We take care of our people who take care of our customers. And that is what, Shri, you must be aware of the famous saying in India, Atiti Devo Bhavo, which means guest is God. I don't think machines have got that far to treat the customers in that form, which is a part of our culture.
I don't think so either. Puneet, it's always wonderful talking to you, sir, and catching up. Thank you very much indeed for your time on Inside India. Puneet Chadwal there from Indian Hotels Company Limited. Thank you, sir. Coming up on the programme, we'll bring you the latest news and updates from around the world. Stay with us. Welcome back. You're watching Inside India. Some of the stories we're keeping tabs on. The Indian Parliament clearing a new income tax bill that replaces the 60-year-old Income Tax Act. Indian Finance Minister said no new tax rates were introduced in the bill. The bill aims to simplify tax procedures, reduce compliance burdens and introduce a unified tax year. Key changes include shorter text and relief for late filers. Preparations are underway in Alaska for President Trump and President Putin's meeting this Friday. Ahead of that, the Trump administration saying the bilateral meeting will simply be a, quote, listening exercise, tempering expectations for a ceasefire. Trump has also been criticised for leaving Ukraine's Vladimir Zelensky out. Zelensky will instead join a virtual emergency summit with other EU leaders and President Trump today to air their concerns before the president meets with Putin. And Chinese President Xi Jinping spoke with his Brazilian counterpart Lula on the phone on Monday. The two leaders discussed the role of the BRICS and the G20 and the need for multilateralism. According to Chinese state media, Xi suggested that China and Brazil set an example of, quote, unity and self-reliance for the global south. Right, let's bring it closer to home and take a look at Singtel. after the telco announced a massive one-time gain. JP Ong joins us to tell us more. Good morning.
Good morning, Sri. This is the business update for their fiscal first quarter, meaning April to June. And we have to separate the profits on two lines. On one hand, we have the bottom line actually more than quadrupling actually to about 2.8 billion Singapore dollars. And that's because of a one-time gain that they recognized after they divested or sold 1.2% stake in Airtel, as well as gains made from the merger of Intouch and AIS out in Thailand, which they are a significant equity associate in. Now, if you take a look at the underlying profits, actually, when you take out the one-time gain, they were still impressed, up by about 16.7% on a year-on-year basis. So good signs, at least, of growth with regards to for Singtel. It's really coming from a number of places, especially Optus, which was a huge drag on Singtel over the last couple of years. But it seems that because of aggressive cost-cut savings and efficiency measures, Optus itself actually saw their EBIT earnings before interest tax actually grow by about 36.2% to 111 million Singapore dollars. Digital Infraco, which is their data center arm, also seeing growth of EBIT of about 29.4%. So these are two of the main areas that's actually driving growth. A lot of this coming down to lower depreciation charges and also better cost management. So it seems that managing your costs better leads to better gains, at least if you're in the telco business. Now, if you take a look at Singtel, you have to remember that it's also about their presence in other key markets like Indonesia and that of India. If you take a look at Airtel, actually, we'll see the profits after tax for Airtel in India actually grew more than doubled to about 226 million Singapore dollars. Again, highlighting that average revenue per unit in India is improving in what's been known as a notoriously cutthroat and very competitive industry actually in India. And this itself actually saw post-tax contributions jump to about 194 million Singapore dollars. And also one of the reasons why Singtel itself is doing quite well today's session. Good performance from their associates in areas like India, and also better cost management in the markets of Australia, and also with regards to their data center arm. And that all resulting in a better first quarter report card, that is, for Singapore's largest telco.
And the market likes it. Stock up by 3.3%. JP, excellent. Thank you very much indeed for that. Let's turn our attention to cryptocurrencies. This is how they are stacking up. Let's give you Bitcoin trading just under 120,000. Ether, Cardano and XRP seeing a rally after US Treasury Secretary Scott Bessent said the Fed should consider a 50 basis point rate cut at their next meeting. That as US headline inflation came in within market expectations, fueling bets for policy easing and pressuring the US dollar. Lower interest rates make alternative assets with potentially higher returns more attractive. Secretary Bessent has also been tasked by President Trump with selecting a replacement for Fed Chair Powell. Right, we'll have more after this short break. Stay with us on Inside India. Welcome back. We are counting down to the market open in India. This is how we are shaping up. Let's give you the futures picture 15 minutes away from the official open. 24,668 is what is implied. So if that does materialize at the open, that would represent upside of about almost 200 points. Dollar-rupee exchange rate is standing at 87.6475. So a stronger opening could be reflecting hopes that maybe the US-India trade deal and the relationship hasn't been irreparably damaged, and maybe Prime Minister Modi, through direct negotiations with President Trump, can pull it back from the brink. And remember, Indian Express and other local media are reporting that Prime Minister Modi is going to be in the United States next month for the UN General Assembly. So perhaps a meeting with President Trump might be on the cards too. In the meantime, India's market regulator SEBI is planning to ease rules for foreign investors, aiming to attract more long-term capital. SEBI outlining this in its annual report following last week's proposal for a single window clearance system. It has also proposed opening Indian securities to overseas investors, including government-owned firms, sovereign wealth funds and low-risk entities. On the macro front, India's retail inflation dropping to 1.55% in July. That represents the lowest reading in 8 years and slipping below the RBI's comfort zone of 2 to 6%. Decline was mostly driven by a sharp fall in food prices. Vegetable costs plunged over 20%, while pulses were down nearly 14%. Earlier this month, the RBI trimmed its full-year inflation forecast to 3.1% from 3.7%, calling the dip temporary. But it is once again fueling the question if we are due for another cut. Let's put that scenario to Tanvi Gupta Jain, Chief India Economist at UBS Securities. India joins us now. Tanvi, great to have you on the programme. What then, first of all, is inflation at an 8-year low telling us about the underlying health of the economy?
Absolutely. So inflation at an 8-year low, the number was 1.6%. That is a reflection of two things. One is the food prices continue to fall. I would say we have been helped by a very good monsoons of last year, which really helped in lowering cereal and pulses prices. But more importantly, we are seeing a much sharp sequential slowdown in vegetable prices, a trend which I have not seen in the past 3 years or 5 years. So I would say India has been lucky. But what is more important, which I think markets should be focusing on, is that core inflation, excluding gold, also continues to moderate. And that is where the health of the economy comes into picture. Our lead indicators are telling us that the growth momentum in the economy has started to soften, especially in the June quarter onwards. And now there is so much tariff uncertainty, which we think can lead to more downside, not even to India, but the global growth as well.
Interesting. So is India perhaps, Tanvi, on the verge of a deflationary environment, or is it a stretch to suggest that? And does it imply, therefore, that the Reserve Bank of India has got more work to do?
Well, the way the Reserve Bank of India will look at 1 year forward inflation when they arrive at their policy forecast. And the 1 year forward inflation, because of a very strong base effect of this year, will be somewhere around 4.5% to 5%. Our 1 year forward inflation is 4.5%, whereas RBI is at 4.9% for the June quarter. That said, I think what RBI needs to look at is that underlying inflation momentum remains subdued, but there are more growth downside risks emerging because of tariff uncertainty. And we have a 25 to 50 basis point rate cut in our baseline view. Likely the first 25 basis point rate cut should happen in the October policy. That is what we are estimating. Additional 25 basis point rate cut in the December policy will be more a function of what we see on the likelihood of where the tariff structure in India with respect to US settles down, and where are the implications on the global growth because of the tariff uncertainty started to play around.
Tanvi, how much of a wild card is the oil price? And if India, and the reason I ask is if India does face 50% tariffs and a more expensive oil bill to boot, then how does that change the narrative for inflation and headline growth?
Let me start with headline growth and then I will focus on inflation. In
Please.
case the 50% tariff stays, we see a downside to our FY26 GDP growth by almost to the tune of 35 basis points versus our baseline, which is right now 6.4%. For next year, I would say the growth downside is almost to the tune of 60 basis points, where our forecast is still at 6.7%. Now, it's very interesting to explore the Russian angle because today, India was exporting or importing almost to the tune of 35% of its crude oil requirement from Russia. And this is the data for the full FY25. And this number was only 2% in 2022 when the Russian-Ukraine conflict happened. The cost advantage that India was getting from buying oil from Russia, which used to be as high as $30 a barrel in 2022, is now down to $2 to $3 a barrel. So I would say if I look at the math, on a net basis, India was getting an advantage to the tune of $2 billion by buying oil from Russia. From an inflation perspective, I don't see too much of a concern. Yes, we might see short-term volatility in global oil prices if India starts, shifting that oil demand from Russia to other countries. But largely because of where we are on the supply-demand dynamics, I think the global oil prices should be okay. So not too much of an impact is what we are building in our forecast. If Russian oil gets shifted and, India starts buying oil from other countries.
There is time, though, isn't there, before this additional 25% tariff does kick in until August the 27th, I think, is the deadline. So negotiations are underway. The US negotiating team is due in India on August the 25th. That's going to be a very important date. We're also hearing from the local media, I'm sure you've heard these reports as well, Tanvi, that Prime Minister Modi is going to the US ostensibly for the UN General Assembly, but could also meet President Trump and maybe pull back this trade deal from the brink and maybe call off the additional 25%. Markets seem to be responding favorably to that. What sort of outcome are you pricing?
So right now, I would say yes. We are hoping that some kind of negotiations turn out between India and US, and that additional 25% tariff, gets rolled back. If I look at the baseline tariff of 25%, it is still higher than China. It is still higher than most of the other Asian peers, which were somewhere between 15 and 19%. But I think this is still manageable. But if we do end up seeing that in the last week of August, as you rightly mentioned, the US delegation is in India and we do see some kind of consensus on the additional 25% tariff, I think it will bode well even from a market expectation as well as the downside risk to growth that we are pricing in. Clearly a win-win situation for India if there is some kind of consensus that can be reached for the additional 25%, which is getting effective from 28th of August.
What are your thoughts on the fiscal side of town, Tanvi? And if India's economy is going into a soft patch, and let's hope that it's not a growth scare, then there's clearly more fiscal work to do. And this entire narrative of fiscal discipline is going to have to be put on the back burner.
I think the most important metric which the market should look at is not the real GDP growth, but the nominal GDP growth this year. And in our opinion, the nominal GDP growth could slow down somewhere between 8.5%, 9%, almost at a 6-year low if I exclude the pandemic period. And if I look at the last 2-year average was almost to the tune of 11%. And when you look at the fiscal math, all the fiscal math the government laid out in the budget were based on a 10.1% nominal GDP growth. So clearly, if a nominal GDP growth slides down, the buffer or the scope for counter-cyclical fiscal policy from the government point of view continues to be limited. That's why we are saying that the entire focus needs to be on monetary policy. We have already seen front-loading of rate cut in the form of 100 basis points, and there is definitely room of another 25 to 50 basis points. That said, there are sectors which are getting affected because of higher tariff, and these are low value-added, low-margin sectors, especially gems and jewelry, textile, apparel, etc., where we would expect the government targeted support measures to be announced sooner than later. And there will be a fiscal cost to it. So I would say definitely we need a counter-cyclical fiscal and monetary policy.
Yes.
So let's see what government focuses right now.
How worried are you about rising unemployment?
If I look at the unemployment numbers, at least the official quoted numbers, I think the unemployment levels are back to where it was during the pre-pandemic period. And I think one very interesting anecdote, which I think generally investors, when they're looking at India, they are not looking at, is that in the last 3 years post the pandemic, we created almost 1.5 to 2 million jobs under global capability centers. And these are high-paying jobs. And one high-paying jobs create 2 to 3 low-paying jobs. And I think that is something I would say almost after 2 decades, we created high-paying, highly mid-level skilled jobs in India post the pandemic. And we are quite excited about that because that is still, we are seeing a lot of demand under the GCC area, which are definitely not going to get impacted, at least for now, because of these trade tariff uncertainty.
Tanvi, great conversation. We'll leave it there, ma'am. Thank you very much indeed for joining me on Inside India. Tanvi Gupta Jain there from UBS Securities India. Now, we are counting down to the market open in Mumbai. We are back in 2 minutes. We're in the pre-open stage for the Indian markets, and let's take a look at the pricing for the benchmark, the Nifty 50 in the pre-open stage at 24,586. Dollar-rupee exchange rate stable at 87.6162. Take a closer look at some of the movers in the Indian markets today. Oil India's Q1 profit plunges 45%, missing estimates, hit by a drop in crude oil prices. The state-run oil firm's crude price realisation fell 22% on year, despite strong demand for both gasoline and aviation fuel. Revenue fell 14%. Shares are looking like this at the pre-open at 426. Oil India's rival, ONGC, also reported after market hours, seeing an 18% rise in net profit. However, revenue still dropped over 3%. ONGC also unveiled plans to invest around 50 billion rupees in renewable energy. Meanwhile, Indian healthcare group Apollo Hospitals will be doubling its AI investments in the next 2 to 3 years. This as the hospital chain beat on both its top and bottom lines in the first quarter and expects double-digit revenue growth in its current financial year. Apollo already makes use of AI tools to read X-rays and scan reports. Earlier this year, it teamed up with Microsoft to develop AI-based healthcare tools, some of which are in the early stage of testing. Staying with the healthcare space, India is moving to overhaul its drug approval process. Earlier this month, the Drugs Standard Control Authority approved new guidelines, including the formation of subject expert committees to advise on product approvals. Currently launching a new drug in India faces long delays. It could take up to 4 years longer compared to the US and EU, according to the Organisation of Pharmaceutical Producers of India. Apart from this, US tariffs could also be crucial for the Indian pharma sector. Right now, the sector is exempt, but President Trump has said he is considering phased tariffs that could go up to 250%. Let's bring in Sakshi Sikka now, Senior Pharmaceutical and Healthcare Analyst at BMI, to talk about these domestic reforms and the external challenges to the sector. Sakshi, welcome to the programme. Let's start with the tariffs. And it is, as we said there, unclear if pharma is exempt or going to be ultimately subject to tariffs as high as 250%. What's your expectation and how is the industry expected to adjust to this?
Sure. Thank you for having me. So firstly, I want to mention that, as you rightly said, negotiations between the US and India remain ongoing, with the next round scheduled for August 25th of this month. And despite existing tensions, we do not anticipate a significant escalation, just because India holds a vital position in the US Indo-Pacific strategy, and particularly as a counterbalance to mainland China. And since negotiations are still on the table, there is potential for both markets to eventually secure a deal. Now, coming to the pharmaceutical sector, there's mixed news for India's pharmaceutical industry with regards to the US tariffs. So while pharmaceuticals, which are India's largest export to the US at about 38%, are currently exempt from the recently imposed 50% tariffs on Indian goods. But we see that the pharmaceutical industry still faces a threat, as you rightly mentioned. So President Trump has specifically indicated plans for global pharmaceutical tariffs that could severely impact India's generic drug manufacturers. And these are companies such as Sun Pharmaceutical, Dr. Reddy's Lab, Cipla, as well as Aurobindo Pharma. And President Trump has outlined a phased approach, beginning with what he has called a small tariff on pharmaceuticals, which would then escalate dramatically to about 150% and eventually to 250% within the next 18 months. Now, the potential imposition of these tariffs would significantly impact India-based generic drug makers, as I mentioned, as their tight profit margins would not allow them to easily absorb the increasing exporting costs. And ultimately, this will then reduce their competitiveness in the US market and force them to lower the US export volumes.
So, Sakshi, in terms of the workaround, especially for the generics drug producers and manufacturers, is it necessary then for to search out alternative markets to hedge their bets more widely, and are they doing so?
Yes, that's right. So while the US currently represents the largest pharmaceutical export market for India, the risk of increased tariffs is likely to accelerate India's push to diversify its trade relationships when it comes to pharmaceutical exports. And South Africa is the next biggest market for Indian generic drug makers to export the generic medicines. And also we are seeing that in anticipation of the potential tariffs, a lot of the Indian pharmaceutical companies, they're already taking strategic action when it comes to expanding their US operations as well. So companies that have more than a certain percentage of their revenues coming from the US market are really the ones that will continue to set up facilities in the US as a means to prepare for any potential risks. And a notable example of this trend is Zydus Life Sciences, which recently acquired a biologics facilities in California.
Interesting dimension, especially with the shift towards South Africa. Sakshi, just turning domestically and the reforms in the domestic pharmaceutical sector ostensibly aimed at streamlining the approval process. Ultimately, what does it mean for India's patients and India's consumers? Does it mean more affordable healthcare?
Right. So we see India's pharmaceutical landscape is undergoing significant transformation despite the tariff uncertainty. And the most recent being India's drug regulator reforming its guidelines on how expert panels review new drugs as well as medical devices for approval. So these reforms really aim to address the critical delays in India's current approval process by establishing clear protocols for the subject expert committees that really advise on product approvals. So according to the Organization of Pharmaceutical Producers of India, currently launching a new drug in India is severely delayed by up to 4 years. And this is in comparison to markets like the US and the EU. Now, with the positive reform on the streamlined approvals, it will reduce regulatory barriers and accelerate market access for both domestic as well as foreign pharmaceutical companies. Next, we also saw back in August of last year that the drug regulator again introduced a waiver of local clinical trials for drugs that have already been approved in major global markets. Again, these are markets such as the US and EU. So this decision again aims to speed up the availability of new medicines, and as a result, it is likely to draw more foreign pharmaceutical companies to India's market. And because of these positive initiatives, we at BMI forecast India's pharmaceutical market to grow at about 5.9% in local currency terms till the year 2029.
In terms of the verticals within healthcare and the treatment areas, what parts of the industry and what parts of the market does this benefit or impact the most, Sakshi? Is it going to be oncology? Is it going to be treatments related to aging? Or could it be what seems to be a trend, let's face it, across the world, and that is GLP and weight loss drugs?
Yeah, that's right. So with the streamlined approval process, it will not only benefit the domestic manufacturers that mainly look at generic medicines, but this will also benefit the international foreign drug makers that want to get their medicines launched in the market. But with that said, we still see that manufacturers will need to remain cognizant of challenges, which includes India's below average healthcare spending as a percentage of GDP, and the continued price controls on essential medicines that the National Pharmaceutical Pricing Authority is implementing. And on top of this, drug makers are still navigating a complex regulatory environment in terms of the intellectual property protection. So while we are seeing that India has demonstrated a commitment when it comes to improving its intellectual property system in recent years, it still lacks concrete measures to meet international standards. And for this reason, we've seen over the last several years that the Pharmaceutical Research and Manufacturers of America Trade Association has recommended placing India on the priority watch list. And this we saw happening in the 2025 special report as well. So this really reflects ongoing concerns from leading multinational drug makers.
How is this policy or these reforms actually going to narrow the divide, narrow the healthcare divide? Because from what I understand, there is cheaper treatment available at public hospitals, but most Indians choose the path of private healthcare, and this is really being driven by perceptions of quality. So does this or do these reforms help narrow the gap and help alleviate those perception issues?
That's right. So one of the aim of the streamlined approvals is also to look at the national essential medicine list and get more approval for the medicines, not just, again, generic manufacturers, but innovative medicines as well, which the population has more access towards. So we see that this list will definitely narrow the gap between the public as well as the private healthcare sector.
Why is healthcare spending as a percentage of GDP below average, Sakshi, in India, and what's going to change that?
Right. So we see that over several years, the budget statements that have been released by the ministers, we see that the healthcare spending is always very negligible, with not a high year-on-year percentage. And even though Narendra Modi ji has announced the launch of universal healthcare coverage and announced various reforms to get more of the population covered, but we still see that it's falling short in terms of the coverage of the population. And also we see that there are several quality issues when it comes to various drugs that get included in the national essential medicine list, which again, the perceived notion of this quality of drugs for the general public is then low.
Yes.
And we recently saw that there were 3,000 substandard drugs that were identified in the market, and this really will then undermine the potential gains that these reforms as well as universal healthcare coverage wants to achieve.
Yes. That is very disturbing from a quality perceptions standpoint and inexcusable on many fronts. Sakshi, thank you very much indeed for joining me on that conversation. Sakshi Sikka there from BMI. Thank you very much. On that note, that's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.